Hello everyone, today I want to talk to you about China issuing US dollar sovereign bonds in Hong Kong. This is a major strategic move. In addition, China has issued a travel advisory for Japan and is now instructing airlines to immediately refund tickets, putting pressure on Japan. There's more to come. Recently, Japanese Prime Minister Sanae Takaichi said that if something happens to Taiwan, it's equivalent to something happening to Japan, and that Japan might send troops to intervene in Taiwan. These remarks have drawn repeated and strong warnings from China's Ministry of Foreign Affairs. On November 14th, The Times pointed out that Prime Minister Sanae Takaichi's remarks about Taiwan have drawn a series of harsh criticisms from Beijing. This not only marks the end of her honeymoon period with China, but also signals the return of Beijing's wolf warrior diplomacy. According to The Times, as Japan's first female Prime Minister, Sanae Takaichi has openly defended her stance. Because of the painful memories of World War II, Japan has been embroiled in fierce disputes for decades. The latest controversy stems from Sanae Takaichi's comments during a parliamentary inquiry where she was asked whether a conflict over Taiwan would constitute grounds for action. In response to the question during a crisis situation, she said that if China were to deploy warships and use military force, it could, under any circumstances, be considered a grave crisis situation. This would mean that Japan has the right to exercise collective self-defense and take military action to ensure Taiwan's security. Given the history of colonization, China is particularly sensitive to Japan's statements regarding Taiwan. Furthermore, former Japanese Prime Minister Shinzo Abe, who was Sanae Takaichi's political mentor, also maintained a hawkish stance toward China, but even Abe never clearly outlined how to respond to a Taiwan crisis. This year, several Japanese leaders have merely continued the narrative put forward by Abe in 2021, repeatedly stating that if something happens to Taiwan, it is as if it happens to Japan as well. They are just saying this, and sometimes reports go even further. The initial comments in the announcement have indeed not changed Japan's long-standing support for Taiwan, but they have broken the previous policy convention of avoiding mention of Taiwan under the so-called existential crisis or critical situation. Previously, like its ally the United States, Japan adhered to a policy of strategic ambiguity, being vague about the scenario in which China might use military force against Taiwan. Sometimes it has been mentioned. Now, the political scientist living in Hong Kong and author of the book on China, Gao Jingwen, describes this wave of Chinese conflict as a clear return to China's wolf warrior diplomacy. In addition, China is not just making verbal threats, but is also taking immediate action. On November 14th, the Ministry of Foreign Affairs urgently issued a red alert for travel to Japan, advising Chinese citizens not to go to Japan for the time being. It also stated that since the start of this year, public security in Japan has continued to worsen, with many cases of illegal activities and crimes against Chinese citizens. Several attacks on Chinese citizens in Japan remain unsolved, and the security situation keeps declining. Additionally, it was mentioned that recently, Japanese leaders have made provocative statements about Taiwan, which has seriously damaged the atmosphere for exchanges between Chinese and Japanese people and further increased safety risks for Chinese citizens in Japan. The Ministry of Foreign Affairs and the Chinese Embassy in Japan have called on Chinese citizens already in Japan to closely monitor the local security situation, remain vigilant, and strengthen self-protection. Following the Ministry of Foreign Affairs' reminder for Chinese citizens to avoid traveling to Japan in the near future, several airlines, including Air China, China Southern, and China Eastern, immediately issued notices stating that passengers who have purchased tickets for flights to Japan can change or refund their tickets free of charge. For tickets with travel dates before December 31st and that meet the relevant conditions, the ticket price can be refunded free of charge. China's travel warning will have an impact. In the first half of this year, the number of Chinese tourists visiting Japan was 4.71 million, accounting for about 24% of all foreign visitors to Japan during that period, a significant proportion. Chinese tourists also topped the charts in terms of spending. Experts say that after the Chinese government issued the red alert, Japan's tourism revenue will see a sharp decline, further worsening the Japanese economy. In addition, the website of the National Maritime Administration also announced that from November 17th to 19th, live fire drills will be conducted in certain areas of the East China Sea, and entry into the exercise zone is prohibited. The overlapping exclusive economic zones between China, Japan, and South Korea are highly strategic and sensitive and may pose potential strategic pressure on Japan, South Korea, and the US military in both countries. This is seen as a warning to Japan. To sum it up, First, while American media claim that China has resumed its wolf warrior diplomacy towards Japan, in reality, the most aggressive wolf warrior on the international stage right now is US President Trump. No matter how assertive China is, it can't compare to the US. China would not proactively and aggressively impose tariffs on other countries. Second, from China's decisive action in warning against nuclear tourism and immediately arranging for airlines to refund tickets, it's clear that China is serious. Its countermeasures against Japan have only just begun. Also, there's a rather interesting recent incident. This news barely caught any attention in the media, but in fact, it carries significant meaning and is worth a detailed analysis. On November 5th, the Ministry of Finance issued $4 billion in sovereign bonds in Hong Kong, with total subscriptions reaching $118.2 billion, 30 times the issuance amount, showing extremely enthusiastic demand. This is the first time since 2021, after a 4-year gap, that the Ministry of Finance has once again issued US dollar sovereign bonds in Hong Kong. This batch of bonds comes in both 3-year and 5-year terms. The 3-year bonds have an interest rate of 3.646%, while the 5-year bonds are at 3.787%. On the day the Ministry of Finance issued these bonds, the yields were nearly on par with US Treasury bonds of the same maturity. This time, the types of investors in the US dollar sovereign bonds were diverse and widely distributed geographically. Asian investors accounted for 53%, European investors made up 25%, Middle Eastern investors 16%, and American investors 6%. This shows that US dollar bonds issued by China are particularly popular among Asian and European investors. Although international rating agencies have assigned China a sovereign credit rating of A1, which is 2 notches below the US's AA1 rating, the market response to China's US dollar bond issuance has been enthusiastic. As a result, the final pricing of the interest rate was set directly in line with US Treasury yields of the same maturity. The market's recognition of China's credit is already on par with that of the United States, which shows that the rating standards of those international agencies are outdated and in urgent need of reassessment. Some people ask, China has $3.3 trillion in foreign exchange reserves, and according to data from July this year, China holds $730.7 billion in US Treasury bonds within those reserves. In other words, China holds a large amount of US dollars and US Treasury assets. So why does China need to issue dollar bonds to borrow $4 billion? There can be multiple reasons for this. First, to establish pricing power for Chinese institutions issuing dollar bonds. To prevent Chinese enterprises from having to pay high interest rates when borrowing through dollar bonds, Wang Jian, head of Greater China at JP Morgan Global Corporate Banking, believes that this issuance of China's sovereign dollar bonds will create a linkage with Chinese enterprises investing overseas. When Chinese companies go abroad to invest, they need US dollars, which drives cross-border financing demand. The regular issuance of sovereign dollar bonds provides these Chinese enterprises with a crucial pricing benchmark. The yield on sovereign bonds will become the core reference for Chinese companies issuing bonds overseas, helping to lower their financing costs. Costs and uncertainties. What he means is that when the Chinese government issues sovereign dollar bonds and sets an interest rate, other large state-owned enterprises whose credit is close to that of the country should only have to pay slightly higher interest rates than the level set by China's sovereign dollar bonds when they borrow in US dollars. This way, they won't be forced to pay higher rates due to credit rating pressures. Secondly, developing Hong Kong's bond market. Hong Kong has long had a thriving stock market, but its bond market has lagged behind. Yet, the bond market is one of the major financial investment markets globally. Its supply and demand are centered on US treasuries, and naturally, the US would not come to Hong Kong to issue bonds. Now, with the US not coming, China is stepping in. According to Liao Yujianhua, co-chief executive of HSBC Asia Pacific and mainland China, this time it is the Ministry of Finance that, since 2021, is once again issuing US dollar bonds in Hong Kong. This demonstrates the central government's strong support for the development of Hong Kong as an international financial center and expanding both the depth and breadth of Hong Kong's bond market, which can further enhance Hong Kong's position as Asia's leading bond market. Third, the competition between China and the US. In terms of sovereign credit, looking at it from a macro perspective, this bond issuance is an important symbol of China's financial opening. However, it also represents the long-term financial rivalry between China and the US. For a long time, the pricing power of the US dollar has been in the hands of the Federal Reserve, and global markets have been almost entirely dominated by the US. These bond issuances by China may signal the beginning of a diversification of US dollar pricing power and a reshaping of the global dollar credit system. The total amount of US international debt reached a record high of over $38 trillion for the first time this October. The US is still projected to have a fiscal deficit as high as $1.8 trillion for the current 5-year fiscal period, With the US debt piling up, market confidence in the US is wavering. The yield on China's 10-year RMB government bonds is only 1.81%, while the yield on US 10-year Treasury bonds is 4.15%. Yet, international credit rating agencies still rate US sovereign credit 2 notches higher than China's. How does that make any sense? Some say that buying US treasuries means holding US dollars, while buying Chinese government bonds means holding renminbi, since the renminbi is not yet freely convertible and China's international liquidity is also low. US treasuries and Chinese government bonds are not directly comparable. However, now that the Chinese government is issuing dollar-denominated bonds, the currency factor is removed, and investors are only looking at sovereign credit. Plus, these bonds are listed on the Hong Kong Stock Exchange, so their liquidity is extremely high. This time, the Ministry of Finance issued bonds at a yield close to that of US Treasuries and received a large oversubscription, showing that the market actually has even more confidence in China's credit. If the US continues to run large fiscal and trade deficits in the future, could we see a situation where the yield on Chinese-issued dollar bonds is even lower than that of US Treasury bonds in the long run? If that happens, it would challenge America's financial hegemony, and the pricing power of dollar borrowing would no longer be dominated solely by the US. It would also depend on sovereign credit. This would take the China-US financial rivalry to an even deeper level. Why can China issue dollar-denominated bonds? Issuing bonds is borrowing money. Whether you can borrow depends on your ability to repay. Anyone can borrow in dollars, euros, or yen. As long as someone trusts you to lend, that's all it takes. China holds about $3.3 trillion in foreign reserves, including $730.7 billion in US Treasury bonds. So why wouldn't people think China can repay its dollar-denominated debts? By contrast, the US has $38 trillion in national debt, but not much in foreign reserves to back it. Is China's ability to repay debt actually better than America's? It doesn't seem like China is just borrowing new debt to pay off old debt like the US does. In the future, we'll see if China only issues a small amount of dollar-denominated sovereign bonds as a pricing benchmark, or continues to issue large amounts of dollar bonds. If China keeps issuing large amounts of dollar bonds long-term, there's clearly a bigger plan. It's not just about growing Hong Kong's bond market or setting benchmarks for state-owned firms to borrow. Now that China-US relations are improving, China probably won't make any big moves to sell its $730 billion in US Treasuries. But if tensions rise again and the US defaults, as long as China keeps issuing dollar bonds and the total exceeds $700 billion, that could solve the problem. China can use these $700 billion to pay its debts. The US might refuse to repay China, but can it really refuse to pay back market investors? If so, wouldn't the Treasury market collapse? In short, China is making a big strategic move. In the next 10 to 20 years, financial rivalry between China and the US will be a spectacle, and it's not over.